Welcome to the latest edition of the JMI Wealth monthly video series. Now, at the most recent video update, we talked quite a lot about uncertainty and volatility, and unfortunately both have been our constant companions as April has seen no reprieve from pressure on share markets. Now, the three main US indexes that we look at, the S&P 500, the Dow Jones, the Nasdaq, they've all lost further ground so far this month. However, on a more positive note, Australasian markets have fared comparatively better, and at the time of recording of this video, the Australian index, the ASX 200, in New Zealand dollar terms is in positive territory for the month of April. Just talking about share market performance, talking about expectations, does raise a couple of important points that I'd like to talk to and expand on a little bit. April always brings with it the US reporting season for the first 3 months of 2022. And as we've previously talked about, the long-term underlying relationship between company earnings and share market performance is relevant here. In a very general sense, as earnings improves, company earnings improve, this provides support for share market gains. Now, at the time of recording, the US earnings season is only partially completed, but reporting so far has exceeded analyst expectations in terms of reported earnings. And look, although there is some caution over forward guidance, there does not appear to be at this stage any widespread negativity about forecast earnings. We do need to talk about the villain, the black cloud of 2022, and that's inflation. Now, we've recently had the release of the latest updates to consumer price inflation, both in the US and here in New Zealand. Now, certainly the villain is living up to expectations. Inflation in New Zealand is running at 6.9% per annum. That's the highest level that we've seen in over 30 years. In the US, the headline number was even higher. It was at a 40-year high of 7.9%. In both cases, though, what we call core inflation was lower, but still well above the respective central bank target ranges. Now, this rapid rise in inflation in certain jurisdictions is really prompting central banks to front load what were anticipated lifts in their cash rates. So here in New Zealand, the official cash rate has recently been lifted by 50 basis points, and I wouldn't be surprised to see another 50 basis point move at the next meeting. Now, in the United States, a 50 basis point hike is also highly likely at the next meeting when the Federal Reserve considers their federal funds target rate. But look, the real story here is how quickly the central banks will now have to move to what I call normalized monetary policy. So that's moving the cash rate up so that you get those rates back to what we consider neutral levels. So not stimulating the economy, but at the same time as they're doing this, they've also got to unwind some of the quantitative easing that was implemented to cope with that economic fallout caused by the onset of the coronavirus pandemic. And just to add to all of that current uncertainty, we've got COVID lockdowns in the world's biggest economy in China, and this is involving tens of millions of residents of some of China's largest urban areas. And these moves could stymie that anticipated easing in the supply chain issues and draw out the return to more normal levels of price stability by adding yet another short-term shot in the arm to inflation pressures. What we do need to also consider is that financial markets, though, are by their very nature forward-looking. That means that the conversation will at some stage gravitate to when we may see the peak in inflation. We know it's a concern, but when will it peak? Now, markets will start to anticipate at what stage inflation will start to abate. Now, it's too early for that conversation to be meaningful at the moment, as there are still upside risks to inflation and certainly persistency risks about how long inflation will be sticky. But history has taught us that if central banks act, they will bring inflation back under control, acknowledging the very difficult job that they're going to have in taming the inflation monster without causing a hard economic landing and recession. Portfolio composition is really important in times like this, and it will remain a challenging environment, I think, for high growth companies until interest rates start to plateau. So we prefer tilting or biasing your share market exposure to fund managers with a value investment style or to companies with value characteristics. And we believe that that approach will reap comparatively better returns. But look, it is, I acknowledge, it's unsettling watching your portfolio value move around, and that's when professional advice is a great idea. So, as ever, feel free to give us a call and we can get an advisor to sit down and have a chat with you, check in on the portfolio settings if you have one, have a little think about your investment objectives and your risk tolerance, and just make sure that your current portfolio does in fact reflect and is consistent with those investment objectives and your risk tolerance. So look, we'd love to hear from you, as always, so jump onto jmiwealth.co.nz, all our contact details are there, and I look forward to talking to you again soon.